Welcome to InvestorHubX.com. In this video, we're going to break down support and resistance, what they are, why they matter, and how to identify strong levels using a simple framework. Let's get started. So, what is support and resistance? Support and resistance are areas where price has reacted in the past and can potentially react again in the future. Support is where price previously stopped falling. Resistance is where price previously stopped rising. When price reverses at two or more points at the bottom, we can draw a line connecting those points. This is called a support level. Similarly, when price reverses at two or more points at the top, we can draw a line connecting those points. This is called a resistance level. These reactions happen because traders made decisions there: buying, selling, taking profit, or exiting positions. Next, why do we draw support and resistance levels? We draw support and resistance levels because when price returns to these areas, possible trade opportunities can appear. They are not signals, not guarantees, just reminders to pay attention. Having these levels drawn ahead of time keeps you prepared instead of reacting emotionally in the moment. So, what are the criteria for identifying strong support and resistance? Not every level on the chart is important. To filter out weak levels, we evaluate each one using 5 criteria. The first thing we look for is swing highs and swing lows. These are the highest and lowest points price has reached in recent time, where direction clearly changed. These points represent moments where the market failed to continue. The second criterion is multiple rejections. The more times price rejects an area, the better. Multiple rejections tell us that traders reacted to this level at different points in time. That increases the chance that traders are still watching it. For example, this is an area where price has rejected multiple times before reversing. We can draw a support level here. When price revisits this level, it becomes an area of interest for traders. The next criteria is that the level should be obvious. This is very important. A strong level should be obvious. It should jump out at you within seconds. The more obvious a level is, the more traders are likely watching it. And when many traders are watching the same level, reactions become more likely. If you have to force it, explain it or zoom in excessively. It's probably not a strong level. Next, we look at how price moved away from the level. Strong levels often lead to strong moves, not just small bounces. A drastic move tells us there was an imbalance between buyers and sellers. That imbalance is what creates meaningful support and resistance. The next criteria is previous resistance becomes support. The strongest levels often switch roles. Previous resistance becomes support. Previous support becomes resistance. This shows that the level is deeply respected by the market from both sides. It's a sign of strong market memory. To recap, the 5 criteria are: swing high, swing lows, multiple rejections in an area, the level should be obvious, move away should be drastic, the level acted as both support and resistances. You do not need all 5 criteria, but the more criteria a level meets, the stronger the level. To keep things simple, at InvestorHubX we score each level. Each criterion met earns 1 point. Higher score, better level. Support and resistance are not predictions. They are areas where price previously reacted and where we pay attention again. Our job is not to be precise. Our job is to be prepared. In the next lesson, we'll focus on how to draw support and resistance properly without cluttering your chart or overcomplicating the process. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. Thank you for watching. I will see you in the next video.